All right, yield nerds, let us see if we can talk about duration. And this is the time to talk about duration because, as you know, Chairman Powell just increased the rates by another quarter point. So we have the highest rates we've ever had in the last 20 plus years. New subscribers, quick note, there is a playlist called the Income Investing Roadmap that has everything in sequential order. So I would suggest you use that. My usual caveat in front of every single episode, this is not investment or tax advice. This is certainly not stock picking advice. This is education. I am not a wealth management advisor and I'm not representing anybody. I'm not sponsored by anybody either. The way the show is going to be organized for this episode, we're going to talk about the background of where we are. We're going to review what yield investing principles are best given where we are today. Look at a couple of value investing lessons from the past and where we should go. And are there storm clouds ahead? If so, what are they? And finally, how can we plan between now and September 30th? We'll talk about the significance of that date shortly. The background as to how we got to where we got to. The Fed has signaled that they will continue fighting inflation until it's about 2%. We may be near peak interest rates. I don't know. Maybe it'll go up a little more. It certainly is not going to go up to double of what it is based on the information we have today. And what I do firmly believe is that doesn't mean that there is a drop in interest rates around the corner. And that is all informed by the fact that interest rates are intended to control the unemployment rate, inflation, and the growth of the economy. And we certainly don't have a perfect curve. The whole mythical soft landing is not happening. And if you want to believe that, you be you. I certainly do not. So having said that, we do this thing called the Yield Super Bowl. You can watch the previous episode. The content here is the same as before. You may remember that as of a couple of weeks ago, in the less than 1 year duration, treasuries are king, queen, and bishop. In anything more than 1 year, callable agency bonds are the best investment. Having said that, I personally have some doubts about callable agency bonds for the specific reason here. If you looked at how the curve is changing, 2 weeks ago, or this would be 3 weeks ago right now, callable agencies would go north of 6.5% tax adjusted, and you have to look at the previous episode to understand what I mean by that. But even a week ago, tax adjusted callable agency bond yields started crashing and treasury yields started crashing as well. And so the difference between the real short-term treasuries, the 3 and 6 monthers, and the much longer duration callable agency bonds is barely 0.5%, if that. And so given a choice between a really low duration and a longer duration in a callable bond, it's your guess is as good as mine. I would think callable bonds will get called when interest rates drop. So it makes no sense to hold long duration. That is something I believe in. So what does that mean in terms of yield investing principles? The potential conclusion is that if you can buy treasuries, which have rarely been called, unfortunately, if you can buy treasuries that are at the 2 year duration, they go north of 5% now, and that is before you add in the state tax credit because they're not state taxable. That sounds like a great thing to do right now. About 10% of my bond portfolio, I'm slowly moving it north of the 3 month mark to 6 months, 12 months, things like that. The vast majority of my bonds are in the 4 month duration, and there is a reason for that. We'll talk more about it. And I personally have stopped buying longer duration agency bonds because the premium that I can get on the longer duration agency bonds are no longer as rosy compared to the really short duration treasury bonds. And you may remember from previous episodes, it's only a couple of different agencies that are state tax exempt, so I don't want to put all my eggs in one basket, so to speak. Having said that, I do go value stock hunting now and then to preserve yield. And I am not a rash moving person. I do not day trade in stocks. I generally hold them for a very long period of time. And I'll talk more about my portfolio later today as well. So what are the value investing reminders if you kind of hold that as true? The very first area I'm going to point you to is a Bloomberg article called Warren Buffett Lifts Fossil Fuel Bets. The great Buffett focuses on two parameters. He has dumbed it down to just those two. If the PE ratio, price to earnings ratio is low, meaning for $1 of profit, if I don't have to pay many, many dollars up front, that's a good thing, because over a period of time, that dollar of profit will keep paying me back. The second is cash flow. Cash flow is defined as the earnings before interest. And if the company has no debt, there is no interest. But after taxes, so it is the after-tax income available that they can then use to pay investors as dividends, they can do acquisitions, and it also adds back, the definition of cash flow also adds back depreciation and amortization, which are funky non-cash expenses. So if you can do EBIT plus DA, earnings before interest after taxes plus depreciation and amortization, you get this number called cash flow. And Buffett says, I don't want to pay a lot in PE, I don't want to pay a lot in price to earnings, and I would love for the company to be a money printing machine, high cash flow. And when you look at the industries, there is something that jumps out. Energy stocks have the lowest PE ratio among any sector in the market and the highest cash flow per share. Said differently, it costs the least in terms of paying multiples of profit for energy stocks, and they make the most money that the owners can decide to do whatever they want with. And even with the dropping energy prices, even with the lower demand, go check, dividends have not dropped at all for energy stocks. And the reason is, in part, because if they drop dividends and their price crashes even further, they already are the cheapest thing on the planet, there would be huge consolidations coming their way. So they're kind of like, I'm going to keep you happy. I'm going to buy stock back so I have more control. I'm going to give you more in dividends. And so there's something interesting going on, and it attracts value investors like the great Mr. Buffett. And if you look on the lower end of the spectrum, you've got technology stocks where we are allegedly, not me, we are allegedly okay with paying 35 times earnings, 36 times earnings instead of 5. In other words, the same dollar in earnings, you are willing to pay $3 to $5 if you are an energy investor, but somehow you convince yourself that $1 in earnings is worth $35 in share price if you are a technology investor. You do you. I am not one of you technology investors. Let's keep going. What is the value investment baby? If we add more arms and legs and hair and all of that to Warren Buffett's two simple criterias, PE ratio, cash flow. If you added more, you would argue they should have very little or no debt. This way, their I in the EBIT plus DA is very little or zero. You would argue they should have really low enterprise value. What I mean by that is they should have a ton of cash in the bank, and those two together automatically lead to a low PE ratio because you're not paying a lot for them. They have a lot of cash, and the cash flow as defined by EBIT plus DA will be very rosy. And hey, if you give me a good dividend, I'd like that too. And your price to cash flow, meaning the price per share as a multiple of the cash flow per share, I'd like for it to be as low as possible. And I'd like for you to have a ton of cash so you can afford your dividends and then some, and a high volume. I set up this screener. I use this every time I go look for qualifying equities. I will save you the suspense. 0 tech stocks meet this criteria. 0. So let's continue on. Conflict of interest warning. I'm going to review my portfolio. You do you. You may remember a couple, 3 weeks ago, we talked about Mueller Industries, MLI, EPM, Evolution Petroleum. They may go up, they may go down, but they have a ton of cash to pay dividends, and they are very sound fiscally, is my assessment. And again, you make your own assessment. Last week, we reviewed CHK, which is Chesapeake Energy, and Calmaine Foods. Again, a lot of cash in the bank, a lot of cash flow, little or no debt. So I just sit there and watch what's going on there. I do own them. I thought for a change, I will show you my value investment portfolio. And I will show you the ugly as well, but initially it looks like I am a genius. Everything I pick is appreciated, and that is not true. We'll look at the bodies here in a second. But most of my value investments are in oil and gas for the reasons we talked about earlier. And one thing I'll point out to you is that the dividend yield, for example, for 1OK shows up as 5.7. My actual dividend yield is closer to 11.4, and here is why. I bought the stock when the price was half of what it is today. And it paid 11% when the price was half of what it is today. When the share price has increased, the people who buy it today make a 5.7% dividend, but I make 11.4% dividend. The opposite is also true. If I own a stock that has crashed by 50%, my dividend yield is not what the market shows for a new investor. My dividend yield is half of that. So remember that. So, be careful about looking at dividends and thinking you're making a certain number. You have to take your gain or loss into account. But as you can see, I have a ton of oil and gas in my value portfolio. I do shop for enterprise value and tax advantages. AbbVie, and I'm not suggesting you buy or not buy, AbbVie does not have state taxes on their dividends in Illinois. It's kind of one of their economic development zone arrangements they have. So if you own AbbVie and it pays qualified dividends, you pay a lower federal income tax rate. You also don't pay any state income tax rate. So there are some funny things you can do. Google in your home state what the economic development zone companies are. In Illinois, it's AbbVie and Caterpillar as an example. In a different state, it might be somebody else. These are companies where the state says, thank you for bringing jobs. If you issue dividends, your shareholders don't have to pay state taxes. And so there are all these interesting incentives that happen there. Couple of things here. There's another segment of my value investment portfolio, again, dominated by oil and gas, but I also have a ton of food. The reason I like food and oil and gas is because most of the attention is focused towards non-food, non-energy stocks. Inflation is measured as excluding food and energy. And I'm like, great, if you exclude that, you're not minding the house, so I will go buy those. And if you apply value investment principles, those two kind of meet the target there very, very well. So that is the basis of my buying those. And again, there are a couple of exceptions. I have some that I purely buy because of their cash in the bank and the free cash flow. Well, we read some articles in the news that said there are many investors now who think the yield has tapped out, and so they're buying dividend stocks. I did a mistake a year ago, and I'll show you where my bodies are buried. Here are a whole bunch of stocks that I bought a year ago, and I am getting kicked on all of those. And in part, it was because I did not really think about value investing well. And in part, it was because of unpredictable events. Alico is an orange grove farmer in Florida, and a storm came and wiped out their orange groves. Nothing anybody can do about that. Star Bulk is in the bulk shipment business through the Suez Canal and in the Middle East and with from Ukraine and Europe, and you know what's going on there. And so there are things that have gone up and down, and that holds for anybody. I certainly am one of them. And so the only thing that gives me solace is that when I put everything together, I get a very healthy 4.6% mostly qualified dividend out of my equity portfolio, and I'm down 2%, which I'm fine with. And there is another reason why I'm fine with that, because equities are a very small portion of my portfolio. I am a true yield nerd. 86% of my wealth that is invested is in fixed income. My equity portfolio is tiny, and the reason it is tiny is because I went to mostly fixed income about a year-ish ago, and I'm slowly entering equity, only buying value investments, otherwise just waiting and watching what is going on. And speaking of what is going on, I'm not rushing to buy more equity because I think equities are going to get cheaper again in a couple of months, and here's why. The two parties are not agreeing with each other. They came together, as you know, a couple of months ago when they passed the bipartisan debt deal. It allowed the country to borrow, but we don't have agreement on whether they can spend or not. And what that means is towards the end of September, there may be threats of a government shutdown. And if the government shuts down, things will rattle in the equity market. As long as you've invested properly, you bought value stocks, you should be fine. If you bought things where you paid a very high number and it's a discretionary stock, it's something that's not absolutely necessary, you may be up for a rough ride in a couple of months. So my thought process in all of this between now and September 30th is to keep dry powder, short-term treasuries that mature right after October. And I only buy equities. As you know, I have about 10-12% in equities. I just sit on fixed income. I keep a good chunk in the extremely low duration, and I'm hoping there is a reasonable compromise. Otherwise, I'm going to position myself to buy equities right at the beginning of October, as long as they meet the PE criteria, the cash flow criteria, and then some. Thank you for listening to Yield Dirt.